What if I told you that one of the most vital AI memory companies on the entire planet just lost nearly half of its value in a matter of days, and yet it's sitting on a fortress-like $42 billion financial moat? How does a company this strong bleed out this fast? Welcome back to the channel. Today we are tearing down what might just be the single most misunderstood market event of the entire year. This is the SanDisk story, the story of a brutal 45% sell-off that could actually be quietly setting the stage for massive, life-changing gains. We're looking at SanDisk, ticker symbol SNDK. This stock just suffered a devastating anomaly in its price action, and right now, retail investors are panic selling into oblivion. But behind the scenes, institutional money is quietly, aggressively positioning for what could be an absolutely violent asymmetric short squeeze. Over the next few minutes, we are going to break down the exact structural data behind this massive sell-off. We're going to reveal the hidden options trades Wall Street is making right now, and we're going to uncover one specific metric later in this video that completely flips the entire narrative around this stock on its head. Make sure you stick around for that part, because the math we're about to look at is genuinely staggering. Real quick, if you're the kind of investor who loves finding these deep value, misunderstood setups before the crowd catches on, do me a favor and smash that like button and subscribe. It genuinely helps us keep this research free for everyone. All right, let's get into it. But to understand just how insanely overblown this panic really is, we first have to look at what the baseline expectations were just a few days ago. Because the setup here was actually about as boring as it gets. Heading into the end of July, the technical setup for SanDisk was completely predictable. Analysts were projecting a period of brutal, range-bound chop leading right up to their highly anticipated August 5th earnings report. The technical models charted a very clean channel, strong support sitting right at $1,400 per share, with heavy resistance capping the upside at $1,600. Now, you have to understand something important here. SanDisk is what we call a hypersensitive macro proxy. It has a beta sensitivity of 3.78. In plain English, that means if the broader tech sector or the cloud infrastructure market so much as sneezes, SanDisk catches a massive cold. It is inherently explosively volatile. So bouncing between $1,400 and $1,600, that was completely normal, expected behavior for a stock with this kind of powerful beta, but that expected normality, it completely vanished overnight. And what happened next caught almost everyone off guard. In just 4 trading sessions, the bottom completely fell out. On July 24th, SanDisk closed comfortably inside our expected channel at $1,436.56. Everything looked fine. But then, just like that, the floor vanished. By July 27th, it plummeted straight through that critical $1,400 structural support, crashing down to $1,278. And the bleeding didn't stop there. The very next day, it lost another 14%, cratering down to $1,096 and eventually hitting a truly depressing low of $1,028 by July 29th. We are talking about an over 45% sentiment-driven drawdown from its recent highs. This wasn't just a technical breakdown. This was a total, absolute capitulation of retail confidence. Billions upon billions of dollars in market cap were wiped clean off the map in under a single week. So what in the world actually triggered this absolute bloodbath? What could possibly justify erasing half a company's value in 5 days? Well, if we dig a little deeper into the global news cycle, the answer is honestly shocking. The trigger wasn't a bad earnings report from SanDisk. In fact, it had almost nothing to do with SanDisk at all. It was a complete black swan catalyst coming from halfway across the globe. On July 27th, a Chinese memory chipmaker named Changshin Memory Technologies, or CXMT for short, executed a blockbuster $8.6 billion IPO over in Shanghai, and this stock went absolutely nuclear. It surged 466% on its very first day of trading. This one singular event sparked sweeping industry contagion across the entire sector. The fallout was immediate and brutal. Wall Street suddenly became terrified of Chinese market saturation and the potential for a massive oversupply of memory chips flooding the global market. And this fear collided perfectly with a broader tech sector rotation where investors were already busy pulling their money out of AI infrastructure stocks. In an instant, panic grabbed the wheel and floored the accelerator. Now, on the surface, I'll admit, that actually sounds like a somewhat legitimate reason to sell. But here's the massive, glaring, almost unbelievable flaw hiding inside the market's logic. And once you see it, you can't unsee it. The entire China supply threat driving this crash? It's a speculative mirage. It's smoke. Here is the fundamental reality that the panicking crowd completely missed. CXMT, the company that just IPO'd and caused all this chaos, exclusively manufactures DRAM memory. SanDisk, on the other hand, is a pure-play NAND flash manufacturer. And these are two completely different technologies, serving completely different structural purposes inside modern computing. The market simply dumped SanDisk purely in sympathy with its competitors like Micron and SK Hynix, pricing in a speculative threat that, even in the worst case, would take years and years to actually materialize. Think about that for a second. Wall Street essentially looked at an apple, panicked, and then decided to sell all of its oranges. It is a pure sentiment-driven overreaction, completely and utterly detached from the fundamental health of SanDisk's actual underlying business. And whenever you get this kind of extreme disconnect between cold logic and raw emotion, it creates something very, very special for the smart investors who are paying attention. It creates what we call an asymmetric opportunity zone. Just look at the underlying divergence happening here. The fundamental business reality of SanDisk, meaning their NAND pricing power and their global supply and demand dynamics, all of that remains entirely unchanged. The business is booming. Nothing about the actual operations has gotten worse. And yet, the retail sentiment and the resulting price action has fallen straight off a cliff, dragging the stock down over 45%. Now think about what that means. When the fundamental value of a company holds completely steady while its share price gets violently cut nearly in half due to a misguided panic, you are staring directly at a textbook, generational buying opportunity. That gap, the space between those two very different realities, that is exactly where life-changing wealth gets built. But hey, don't just take my word for it. Let's take a look at exactly what the biggest, most powerful players on Wall Street are actually doing while the retail crowd is busy panic selling. While the amateur traders are frantically fleeing for the exits, smart money and the heavy-hitting institutions are aggressively doubling down. BlackRock recently came right out and stated that this chip stock route is drastically overdone. They argue, quite logically, that cheaper AI infrastructure actually accelerates and lifts the overarching demand for memory chips, not the other way around. Meanwhile, analysts over at Morgan Stanley stepped in and called this drop a strong entry point. They pointed out that the AI-driven memory shortage is a structural, long-term issue that is projected to last for another 3 to 4 years. Let that sink in. The smartest people in the room aren't the least bit worried about a Chinese DRAM company somehow taking out an American NAND giant. No, they are absolutely salivating at this discount. When you actually look at the price targets these institutions are setting for the stock, the upside math becomes almost too good to believe. Is it even possible for a stock to run this far, this fast? The numbers say yes. With the stock currently hovering around these deeply depressed levels near $1,028, the upside potential here is absolutely massive. The current Wall Street consensus target for SanDisk sits at $2,197. But the top-tier firms, they're aiming even higher than that. Bank of America reiterated their buy rating with the $2,500 target. Bernstein just raised theirs all the way up to $3,000. And Susquehanna is incredibly bullish, setting a target of $3,050. We are talking about an implied upside exceeding 100% just to return to the basic consensus, and that's before we even touch the high-end estimates. Think about how remarkable that is. Wall Street analysts have effectively doubled down on their price targets even after watching this thing crash 40%. So what exactly gives these analysts so much rock-solid confidence? Why are they so completely sure that SanDisk simply won't fail here? Well, all comes down to $142 billion secret. And this is the metric I promised you at the start. The secret is their $42 billion contractual shield. This is the single hidden metric that changes absolutely everything about this story. You see, SanDisk is actively evolving its entire business model away from being a cyclical boom-and-bust hardware manufacturer. Instead, they are transitioning into something that looks far more like a software enterprise with incredible, reliable predictability. Here's the key. They have legally locked in over $42 billion in multi-year new business model revenue, and it gets even better. That revenue is backed by $11 billion in strict financial guarantees. This contractual shield completely insulates their operations from the chaos, allowing them to maintain industry-leading gross margins of over 78%, no matter what macro headwinds try to knock them down. Now, combine that massive revenue shield with the way they are actually managing their cash, and things start to look almost unfair, because what you get is one of the most pristine balance sheets in the entire technology sector, full stop. Thanks to this massive, panic-driven sell-off, SanDisk is currently trading at a jaw-dropping valuation of just 6 to 9 times forward earnings. Let me be clear about how absurd that is. For a high-growth AI memory stock, that multiple is outrageously, laughably cheap. But somehow, it gets even better. Thanks to their enormous free cash flow, the company is currently operating with absolutely zero debt. Zero. And then to top the whole thing off, management is so deeply confident in their own intrinsic value that they have gone ahead and initiated a $6 billion share buyback program. In other words, they are actively eating up their own floating supply of shares while the stock is sitting on the discount rack, which sets the stage perfectly for what is easily the most explosive part of this entire analysis, because this is where the setup goes from interesting to potentially explosive. Right now, we are watching three distinct metrics converge together to form the ultimate structural squeeze trap. Let's break down each one. First, bearish retail traders have heavily shorted the stock, causing the short interest to jump 9.17% up to 7.86 million shares. That's roughly 5.32% of the entire float betting against it. Second, the technicals are now deeply oversold, with the relative strength index, the RSI, absolutely crushed down into the 30 to 32 range. And finally, we have an imminent binary event fast approaching, which has pushed implied volatility all the way up to the 98th percentile. Now, when you take massive short interest, add a deeply oversold technical floor, and then combine it with extreme options volatility, what do you get? You get a powder keg. A powder keg primed for a violent upside squeeze. And here's the thing. We know definitively that institutional traders are already out there lighting the fuse on this exact powder keg. Just take a look at the smart money options flow. Institutions recently executed a massive $57 million bullish risk reversal. Now let me walk you through exactly how this powerful move works because it's fascinating. Step A, they aggressively sold $840 put options. By selling those puts, these institutions are legally obligating themselves to buy shares at $840, and in doing so, they create a rock-solid, hard floor sitting underneath the stock. This move signals loud and clear that they have absolutely zero fear of any further downside. Then comes step B. They took the premium they collected from selling all those puts and they used it to purchase massive blocks of $1,520 call options. This is aggressive, leveraged upside targeting, financed entirely by those put sales. In plain terms, they are betting millions and millions of dollars that this stock is about to rip violently higher. And the catalyst that could trigger this exact scenario. They are literally just days away now. We have two absolutely massive binary catalysts arriving back to back. The first one is the August 5th Q4 earnings report. SanDisk has guided for $7.75 billion to $8.25 billion in revenue, alongside an adjusted earnings per share of $30 to $33. Now here's the key. If they even slightly beat those expectations, those over-leveraged short sellers are going to be forced to cover their positions, which itself triggers the squeeze. But even if earnings come in just okay, we immediately roll right into August 13th, which is their investor day. And the entire focus of that day will be management stepping onto the stage and proving to Wall Street that their massive profit margins are durably, contractually locked in all the way through 2027. These two events are the spark plugs for the entire rebound. So the big question is, how do we actually play this? How does a regular investor position for something like this? Well, there are really two distinct ways to execute this, and it all depends on your timeline. If you are a short-term swing trader, your tactical plan is built entirely around this incredible risk-to-reward skew. Right now, your optimal entry zone is sitting right down here at these depressed support levels, between $1,000 and $1,100. Your core strategy is to position yourself for one of two outcomes. Either a rapid pre-earnings run-up as volatility expands, or a post-earnings short squeeze bounce. And if that squeeze does trigger, your target exit zone is a return to the near-term resistance levels, hovering between $1,310 and $1,482. Best of all, your downside risk here is heavily mitigated by those institutional put walls we talked about, while your upside potential is skewed almost entirely in your favor. But if you happen to be someone with a little patience, well, the real wealth generation lies in the broader, longer-term strategic plan. For the long-term shareholders out there, the playbook is beautifully simple. Buy and hold. The idea is to aggressively acquire this dip at these completely unjustified discounted levels. Our core thesis here is a fundamental re-rating of the stock. Right now, the market is actively mispricing SanDisk, still treating it like some traditional boom-and-bust memory cycle company from a decade ago. But here's the catch. Once that $42 billion new business model moat gets proven and verified on August 5th and August 13th, the market is going to be forced to re-rate SanDisk's multiple. And when that happens, this stock is structurally designed to climb right back toward those ultimate Wall Street targets of $2,500 to $3,000 a share. The math is there, the moat is there, and the smart money? It's already locked in. Now, before we wrap this up, I need to be crystal clear with you about something important. Everything you've heard in this video is strictly for educational and informational purposes only. It is absolutely not financial advice. I am not your financial advisor, and I am not recommending that you buy or sell any security. Every single investment carries real risk, including the very real risk of losing your entire principal. Markets can and do move against even the most compelling setups, and no squeeze, no target, and no catalyst is ever guaranteed to play out. So please, always do your own thorough research and seriously consider speaking with a licensed financial professional before you ever put a single dollar into the market. All right, with that said, let's bring it all home. SanDisk represents one of the most fascinating disconnects we've seen all year. A fundamentally booming NAND giant, punished nearly 50% over a threat that doesn't even apply to its technology, also while institutions quietly load up and set the floor. So now I want to hear from you. If SanDisk beats earnings on August 5th and that squeeze actually ignites, how high do you honestly think this stock runs by the end of the year? Drop your price target in the comments below. I read every single one, and I genuinely love to see who calls it closest. And if this deep dive brought you real value today, please do me that quick favor. Smash the like button, hit subscribe, and ring that notification bell so you never miss the next breakdown. Thanks so much for watching, and I'll catch you in the next one.